Why should one invest? Before we address the above question, let us understand what would happen if one chooses not to invest.
Let us assume you earn 50,000 rupees per and you spend 30,000 rupees per towards your cost of living,
which includes housing, food, transport, shopping, medical, etc. The balance of 20,000 rupees per is your monthly surplus. For the sake of simplicity, let us ignore the effect of personal income tax in this discussion.
Let us make a few simple assumptions.
1. The employer is kind enough to give you a 10% salary hike every year. 2. The cost of living is likely to go up by 8% year on year. 3. You are 30 years old and plan to retire at 50. 4. This leaves you with 20 more years to earn. You don't intend to work after you retire. 5. Your expenses are fixed and don't foresee any other expense. 6. The balance cash of 20,000 rupees per is retained in the form of hard cash. If one were to analyze these numbers, you would soon realize this is a scary situation to be in. Few things are quite startling from the calculations. After 20 years of hard work, you have accumulated 1.7 crore rupees. Since your expenses are fixed, your lifestyle has not changed over the years. You probably even suppressed your lifelong aspirations: better home, a better car, vacations, etc. After you retire, assuming the expenses will continue to grow at 8%, 1.7 crore rupees is good enough to sail you through roughly about 8 years of post-retirement life. 8th year onwards, you will be in a very tight spot with literally no savings left to back you up.
What would you do after you run out of all the money in 8 years?
How do you fund your life? Is there a way to ensure that you collect a larger sum at the end of 20 years?
Let's consider another scenario where instead of keeping the cash idle,
you choose to invest the cash in an investment option that grows at, let's say, 12% per annum. For example, in the first year you retain 240,000 rupees per, which when invested at 12% per annum for 20 years yields 2,067,063 rupees per at the end of 20th year. With the decision to invest the surplus cash, your cash balance has increased significantly. The cash balance has grown to 4.26 crore rupees from 1.7 crore rupees. This is a staggering 2.4 times the regular amount. This translates to you being in a much better situation to deal with your post-retirement life. Now, going back to the initial question of why invest, there are a few compelling reasons for one to invest. Reasons to invest. To fight inflation by investing, one can deal better with the inevitable growing cost of living. To create wealth by investing, one can aim to have a better corpus by the end of the defined time period. To meet life's financial aspiration. Where to invest? Fixed income instruments, equity, real estate, commodity. Investments optimally should have a strong mix of all asset classes. It is smart to diversify your investment among the various asset classes. The technique of allocating money across assets classes is termed as asset allocation. Typically, investors should allocate around 70% of their investable amount in equity, 20% in precious metals, and the rest in fixed income investments. The ratio in which one allocates investments across asset classes depends on the investor's risk appetite.
What are the things to know before investing? Risk and return go hand in hand.
Higher the risk, higher the return.
Lower the risk,
lower is the return. Investment in fixed income is a good option if you want to protect your principal amount. It is relatively less risky. However, you have the risk of losing money when you adjust the inflation return. Investment in equities is a great option. It is known to beat inflation over a long period of time. Historically, equity investment has generated returns close to 14 to 15%. However, equity investments can be risky. Real estate investment requires a large outlay of cash and cannot be done with smaller amounts.
Liquidity is another issue with real estate investment. You cannot buy or sell whenever you want.
Gold and silver are relatively safer, but the historical return on such investment has not been very encouraging.